Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 19th, and today's money mood is optimistic forecast, anxious markets, and one very practical reminder that your brokerage app is not down. The market is just closed.
I love when the market is closed. It's the only day my portfolio can't hurt my feelings in real time. Today, we've got IMF vibes, tariff drama, gold going full doomsday chic, and Romania basically saying inflation near 10%. Yeah, we're not cutting anything.
We'll keep it tight and actionable. What happened, the simple finance behind it, and what you can do this week, whether you're investing, budgeting, or just trying to stop doom scrolling your net worth.
And I will be here asking the questions your group chat is too embarrassed to ask. Like, if the IMF is bullish because of AI, does that mean my toaster is about to get venture funding? So the IMF is basically saying the world economy is jogging at a steady pace, but also there are banana peels everywhere. And one of the banana peels is tariffs, right?
Exactly. The simple version, GDP growth is like the speed of the global conveyor belt. AI investment can make the belt faster, more productivity, more output. But tariffs and geopolitics can jam the gears by raising costs and adding uncertainty.
Okay, but when they say AI investment is buttressing growth, is that code for companies are buying GPUs like they're stocking up for the apocalypse?
It's code for CapEx. Companies spending real money on data centers, It's code for CapEx. Companies spending real money on data centers, chips, software, and talent. That spending shows up as investment in GDP today, and if it raises productivity later, it can lift growth for years. The IMF also warns that a reversal in the AI boom is a meaningful risk. If expected productivity doesn't materialize, markets and spending plans can cool fast.
So it's like renovating your kitchen. You spend a ton now, GDP looks great, but if the new layout still makes you trip over the dishwasher, the productivity gains are fake.
Perfect analogy. Why it matters for normal people. If growth holds, job markets tend to stay healthier and wages can keep improving. But if growth is being propped up by a narrow slice, say AI CapEx, then sectors outside that bubble may still feel sluggish, and any policy shock like tariffs can hit prices quickly.
Action item time. What should a regular investor do with 3.3% growth, but risks, besides developing emotional resilience and a second personality?
3 practical moves. 1. Don't anchor your plan to one macro forecast. Rebalance to your target mix on a schedule. 2. If you're heavy in one theme like AI, stress test it. What happens if multiples compress? 3. Keep a cash buffer so you're not forced to sell in a drawdown.
Story 2 is the one where the market says, I don't care about your forecast. I'm scared now. Stocks sank and gold hit fresh records as U.S.-Europe tensions flared, and it's tied to tariff threats and this whole Greenland situation.
What happened? Headlines around renewed tariff threats and broader U.S.-Europe friction pushed markets into risk-off mode. In risk-off, investors sell some stocks and rotate into perceived safety, like gold, especially when policy uncertainty rises.
Explain risk-off, like I'm 5. Or like I'm an adult who still checks their portfolio before brushing their teeth.
It's basically like a neighborhood storm warning. When the forecast looks calm, you host a barbecue. Stocks, high-growth bets. When thunder hits, you bring everything inside. Cash, high-quality bonds, and yes, gold. Because you're prioritizing not losing stuff over gaining stuff.
So gold is the financial equivalent of canned beans, except you can't eat it. But you can stare at it and feel superior.
Gold tends to benefit when real yields fall, the dollar weakens, or uncertainty spikes, though it doesn't move in a straight line. Tariffs matter because they can raise input costs and consumer prices, squeeze corporate margins, and complicate central bank decisions.
And for normal people, tariffs are like a surprise convenience fee on everything. You didn't ask for it, but it's on the receipt, and now you're mad in the parking lot.
Exactly. Actionable angle. If you're worried about policy shocks, focus on what you can control: diversification, position sizing, and time horizon. If you're tempted to chase gold after a record, consider using a small allocation as a hedge rather than a bet the house trade.
Story 3. Romania held rates because inflation is still near 10%, and they're basically refusing to even start the rate cuts group chat until prices chill out.
What happened? Romania's central bank kept one of the highest policy rates in the European Union. The reason is straightforward. With inflation around 10%, cutting rates too early risks reigniting price pressures and weakening credibility.
Simple version, if inflation is a kitchen fire, a rate cut is like turning the fan on because you're hot. It feels good for 2 seconds. Then you've just spread the smoke everywhere.
Yes, high rates are a brake. They make borrowing more expensive, cooling demand and helping inflation come down over time. The trade-off is slower growth and higher debt service costs for households and businesses.
So if you live there, you're paying inflation insurance in the form of higher loan costs. If you don't live there, why should you care, besides being emotionally invested in the word Europe?
Because it's a reminder that the inflation fight isn't uniform. Different countries are in different phases, which affects currencies, bond yields, and cross-border capital flows. For investors, it's a case study in why rates will fall everywhere soon is not a safe assumption.
Before we wrap, today is Martin Luther King Jr. Day in the U.S., so if you try to place a trade and nothing happens, congratulations, you've discovered a holiday. Please do not call customer support like, "Hello, my stocks aren't moving."
What's open and closed? U.S. financial markets are shut and many banks and government offices are closed, though ATMs and online banking typically still work. Use the downtime to review your watch list, check your budget, and set any limit orders for when markets reopen, rather than panic tapping all day.
If this helped, subscribe and share BD Daily Finance News Podcast. And leave a comment with one move you're making this week. Rebalance, build cash buffer, or just stop checking your portfolio before brushing your teeth.
Also, tell us, are you treating gold as a hedge, a hobby, or a personality trait? We'll be back with more finance news you can actually use.